If tax season already humbled you, this is the video you needed. Because the 1099 tax trap does not start when you file. It starts when a client pays you, a brand deal hits, your shop makes sales, or your gig app cashes out. And the biggest mistake is thinking all of that money belongs to you. Because I need you to stop and really hear this. That is the trap. I'm Miss T, the tax fairy, helping you plan, protect, and profit with smarter tax strategy. A portion of that money, sometimes 25%, 30%, or more. Nobody tells you that when the money lands. They wait. They let you spend it. Months can go by while you keep spending money that should have been set aside. Then later, when it is time to file, pay quarterly taxes, or respond to the IRS, the number hits you. This video is your reset, so the same tax mistake does not keep happening every year. This video is your reset, so the same tax mistake does not keep happening every year. This is not about making more money. This is about knowing what part of the money is actually yours. You can earn 6 figures as a freelancer, a content creator, a hairstylist, an Uber driver, a DoorDash courier, or an Etsy seller, and still end up broke if you do not understand how self-employment taxes actually work. Months later, they owe $8,000, $12,000, $17,000, and the money is already gone. The money they have already spent. The worst part, they did not do anything illegal. They just did not know. You're going to learn 8 tax truths that can help you stop getting surprised by taxes year after year. Taxes are not a once-a-year problem when you work for yourself. Stay with me. This is important. Rule 1. You are both the employee and the employer now. When you work for yourself, you owe double the Social Security and Medicare taxes. At a W-2 job, your employer pays half and you pay half. But when you are self-employed, you pay both halves. That includes freelancing, rideshare work, doing hair, selling online, and creating content. That is 15.3% of your net self-employment income before we even talk about income tax. If you made $50,000 as a freelancer, the self-employment tax alone is roughly $7,065. Most people making $50,000 think they will owe a couple thousands. Then they open the tax return and see a number that feels like a gut punch. The trap is that when nothing is withheld, your brain treats the whole amount as yours. Rule 2. The IRS wants to be paid 4 times a year. If you earn income without tax withholding, the IRS expects quarterly estimated tax payments. Taxes are not a once-a-year problem when you work for yourself. Typical due dates fall in April, June, September, and January. You make $3,000 in January, $4,000 in February, and $5,000 in March. After 1 quarter, you could have made $12,000 and paid 0 taxes. If you did not send a payment, penalties can be added. Not knowing the rules does not stop the penalties from showing up. So if you are making 1099 money right now, mark your calendar before the next due date catches you. Rule 3. A 1099 is not a bill. It is a warning. When you receive a 1099, that form has already been reported to the IRS. The payer sends 1 copy to you and 1 copy to the IRS. Then the IRS matches that income to your tax return. If your return does not account for it, that can trigger a notice. You earned $2,800, did not report it, but the business sent a 1099 NEC to the IRS. Small amounts do not always fly under the radar. All income is taxable, unless the tax code specifically says otherwise. Rule 4. Your expenses are your best friend, but only if you track them. The IRS taxes your profit, not your revenue. Every legitimate business expense you fail to track is money you may be giving away. Creator A makes $70,000 and tracks nothing. Creator B tracks camera, microphone, lighting, software, phone bill, and home office expenses. After deductions, Creator B's taxable income drops to $48,000. Same revenue, completely different tax bill. People intend to track receipts, but life happens.
Get a separate business bank account. Use an app to photograph receipts. Make it a habit.
Track it or lose it. Rule 5. The home office deduction is real, but it has rules. If you work from home, you may be entitled to a deduction, but working from your couch, sometimes does not qualify. First, the space must be used regularly and exclusively for business. Second, it must be your principal place of business. A dedicated spare bedroom, used only as your studio, may qualify. Your kitchen table, where you also eat breakfast, probably does not. With the simplified method, you may use $5 per square foot, up to 300 square feet. With the regular method, you calculate the percentage of your home used for business. If your deduction is legitimate and documented, do not leave it on the table. Rule 6, the self-employment tax deduction most people never notice. You can deduct half of your self-employment tax from your income. If your self-employment tax is $7,065, half of that, about $3,532, may reduce your gross income before income tax is calculated. This is not a loophole. This is a built-in part of the system. File correctly so you do not miss it. Rule 7, mixing personal and business money is a trap. When you mix personal and business finances, you make it harder to prove your deductions and track your income. When you mix personal and business finances, you make it harder to prove your deductions and track your income. A client pays you through Venmo into your personal account. You buy a camera lens with the same card you use for groceries. None of this is illegal, but it can create a bookkeeping nightmare. A hairstylist deposits $68,000 into her personal checking account. That same account also shows groceries, Netflix, school supplies, and car insurance. Any expense you cannot prove may be an expense you cannot deduct. You do not need an LLC first. You need separation. Open one today. Rule 8, retirement accounts can lower your tax bill while building your future. As a self-employed person, you may have access to retirement accounts that reduce taxable income. The SEP IRA and solo 401k are two options self-employed workers should know. A SEP IRA may allow you to contribute based on your net self-employment income. Every eligible dollar you contribute can lower the income that gets taxed. If you earn $60,000 and contribute $12,000 to a SEP IRA, your taxable income may drop to $48,000 instead of $60,000. This can help your tax bill and your future at the same time. Do not wait until you feel established to start thinking about this. Let me take you back to where we started. Two people, both self-employed, both make $70,000 a year. Maya was excited when she hit that number and spent the money as it came in. She did not have it, so she went on a payment plan with the IRS. She mixed her accounts, saved nothing for taxes, and tracked nothing. When it was time to file, her tax bill was $14,000. She did not have it, so she went on a payment plan with the IRS. Penalties, interest, stress. Deshaun made the same $70,000. He opened a separate business account and set aside 25 to 30% of every payment. He tracked expenses monthly, paid estimated taxes, and opened the SEP IRA. After deductions and retirement contributions, his taxable income was closer to $42,000. Same income, same type of work, completely different financial reality. The difference was knowledge. Taxes as a self-employed taxpayer are not just a tax season problem. The decisions you make all year decide whether the bill shocks you later. Share this with someone making 1099 money, content creator income, gig income, or business income right now. Share it with the person in your DMs asking how to handle their 1099. Drop one word in the comments right now if this video helped you in any way. And remember to subscribe to the Tax Fairy with Ms. T. Do not let the tax tea spill and miss it.
This content is for educational purposes only and is not legal or personalized tax advice. Tax situations are different for everyone.
So, if you need real tax help, personalized guidance, or support with your tax situation, visit the link in my profile to connect with me, Ms. T, a real tax professional.